Well, good evening, everybody. My name is Brett Immel with Growth Equity Group. I'm going to be presenting this webinar this evening, this beautiful Thursday evening here in Chicago, Illinois. The full moon is still out. I can see it right outside my office. It's pretty incredible last night. If you saw any photos on the news or social media, when you get the summertime full moon here in North America, it's a pretty cool sight. Again, my name is Brett Immel with Growth Equity Group, and we're going to get the presentation started. First of all, I want to thank Investopedia for having us present this to their opt-in database. They have several different databases of investors that are always out there trying to learn about the next best way to invest not only their cash on hand, but their retirement dollars, trying to learn new trends within certain market sectors. Our firm is a nationwide real estate investment firm based out of Chicago, Illinois. I know we do have some international investors on this evening as well. I just got back from a 2-week speaking engagement in Australia. A lot of Australians are looking for different ways to diversify and invest their money in American real estate. For them, our real estate is still absolutely on sale, even with their dollar right now, and a group of Canadians as well. So I want to welcome everybody out to the webinar tonight, and I'm going to get the presentation started. First, I'm going to talk about, and this is only for our American investors, I'm going to talk about self-direction. Self-direction, or a self-directed IRA, what we're going to talk about is a truly self-directed IRA. A lot of individual investors on the webinar this evening might think that they have a self-directed IRA, but while they do have a self-directed IRA, they don't have a truly self-directed IRA. And what I mean by a truly self-directed IRA is those retirement dollars that you have, so either in a Roth IRA, a traditional IRA, an old 401k, those dollars can be invested in alternative assets outside of Wall Street, outside of stocks, bonds, and mutual funds. They can be invested in tangible assets, just like real estate, what I'm going to talk about tonight. They can also be invested in gold. They can be invested in notes. There's all kinds of alternative assets that Wall Street doesn't want us, the investor, to know that they can invest in. But the great part about it is this law has been available, self-direction, since 1974. The problem is only 4% of our population right now is taking advantage of truly self-directing their IRA. Now, when I say self-directing, does that mean it's anything different than an IRA? No. It's more or less a marketing term. And what that is telling you is that you, the individual investor, can take your retirement dollars, again, tax deferred, tax free, and you can take those dollars and you can make your own investing decisions. Does that mean you can't invest in stocks, bonds, and mutual funds? Absolutely not. If you have an IRA today that has, let's say for simple numbers purposes, $100,000 in it, and you want to truly self-direct that IRA, do you have to roll all $100,000 into a truly self-directed? No. If you have your money with Vanguard right now invested in stocks, bonds, and mutual funds, and you want to diversify into something tangible with cash flow, with non-recourse financing, in a market that's going to yield you appreciation, and you want to diversify, could you take $50,000 and move that into a truly self-directed and have essentially 2 different IRA accounts? Absolutely. No problem at all. And I'm going to tell you about that here this evening. So let's talk about the IRA market. Just like I hit on, 4% of IRA dollars, whether it be a Roth IRA or traditional IRA, are in truly self-directed IRAs right now. Ladies and gentlemen, $7.3 trillion right now is invested in IRA dollars. And only 4% of those we are taking advantage of. We are saying, I know what I want to invest in. I know what my future can hold. I understand the markets, and I know that I can do better than the stock market. We're supposed to buy low and sell high, right? Are we at an all-time high? Are we at a high right now? Should we be taking that money out at that high, even though if we're just over 20% over what we made in 2008, or what we lost, excuse me. Should we be taking that money, investing it in other vehicles? Right now is the most amazing time to be investing in real property. What our firm does is we buy developments. I'm going to tell you all about it, and we sell them off to individual investors. Most of our investors are either foreign nationals utilizing their retirement dollars investing into the United States, and about 80% of our clients are individuals who are on this webinar this evening, who were introduced from Investopedia, who know that there's something better for them, that they can double down and really increase those returns and own real estate in the future in their retirement accounts, free and clear. And I'm going to show you how you can do that tonight. So what are some allowable investments in a truly self-directed IRA? Real estate, of course, precious metals, notes and mortgages, private placements. Another thing would be a very popular asset class would be a new corporation, an LLC, where you can take that LLC and you can actually make your own investment decisions with it. I myself invest in 3 of these asset classes on the screen right now. Single family homes, multifamilies. You can buy apartment buildings, condominiums, commercial property, improved or unimproved land. I want to stop right there real quick and talk about, do we want to own land in our retirement account? Because land comes with zero cash flow, but it comes with expenses. While you may own land, do you still want to insure that land against liability? What if a couple kids are out there playing around in your land and somebody gets hurt? Could you be sued? Absolutely. So you want to insure yourself, but that's a cost, right? No cash flow coming in. Are there taxes on that land? Every year. So owning improved or unimproved land within a retirement account, I'm going to say, is somewhat of a risky investment. If you are a skilled investor and you do understand land, and you're in an area that you know that maybe the urban sprawl is coming that way, and you have the reserves in your retirement account to hold on and hopefully get that big hit, sure. But for your everyday investor who could today make double-digit returns with real property, I would say you want to pass on land. Now, leveraged or unleveraged property. I'm so excited to talk about this tonight. Leveraged property. Every piece of real estate that we sell comes with a non-recourse loan in place. We're allowing our clientele to double their retirement investable dollars. It is so exciting to talk about because very few people know that if they had $100,000 in their IRA, in an old 401k, in a Roth IRA, that they could take that and have $200,000 plus of investable dollars into alternative investments. Foreign property investments, Costa Rica, Mexico. They were very popular when the market crashed here in 2008, 2009, because people were trying to figure out what is the next good real estate market? Where should I be investing in? And a lot of people got burnt. They took their money down south to the Caribbean, and literally developers folded, and their money is gone. So we're looking for investments that are here, that have economics 101, that are going to yield our investors the best results. Here's some other assets that you can have. LLCs, LPs, trusts, corporations, joint ventures, structured settlements, investment clubs, hedge funds. All these are available to you with a truly self-directed IRA. Types of self-directed plans, of course, on the tax deferred, you have a traditional spousal IRA, a SEP IRA, which is so powerful. This year, if you are a self-employed individual, you can contribute $53,000 tax deferred. That comes off the top. If you make over $250,000 in your company as a self-employed individual, you can take a have a $53,000 contribution to your IRA, and that can be through a truly self-directed IRA. Imagine that. You could have over a 3-year span, over $150,000. Imagine the amount of real estate, leveraged real estate that you could own. Imagine the amount of debt you could pay off with that real estate and own free and clear when you retire. That is so powerful. A simple IRA, defined benefit plans for those individuals who are business owners. The defined benefit plan is so powerful, and you can self-direct it. Defined contribution plan. Now over on the tax-free side, of course, we have HSAs, Roth IRAs, educational savings account, and a Roth like 401k. Now that's a very unique strategy that we would have to talk to you on a one-on-one basis. So those of you, we have over 500 people on this webinar this evening. Those of you who are doubtful of what you can do in that IRA, you can jot these publications and regulations down. IRA Pub 590 and 5305 will really give you the big outlook, and then IRS Regulation 4975. So of course, 3 different tax environments. Taxable, cash on hand. If you have cash on hand and want to invest, it's a great way to invest. You get all the benefits of depreciation. You get all the benefits of owning real estate. You get all the benefits of cash in your hand today. Tax deferred, are you going to pay tax in the future? Absolutely. But how powerful can you make it? And can you switch a tax deferred account to a Roth account at any time and pay the tax? Of course. And then the most powerful investing tool today is the tax-free, is the Roth IRA. 3 ways to fund an investment outright. That's cash or with your IRA funds. Directly purchase it. But why would you do that if you can leverage your investment? Real estate and leverage lay in bed together so well. That is the only way to truly purchase, invest income-producing real estate and double down and be able to really grow your portfolio. Could you partner with someone? A lot of our clients today, we had a client that was a husband and wife. The wife had $30,000 in her account, and the husband had $200,000 in his account. But they wanted to purchase the assets, the portfolio together. So we were able to vest the ownership of the portfolio of real estate that they purchased accordingly to the amount of dollars that they were contributing. Does the IRS say that's okay? Absolutely. Is there prohibited parties you can do business with? There is. You want to look away from lineal transactions, meaning your son, your daughter, your father, your mother, your grandmother. You cannot do business with them. Your brother, your sister, sure. Now, again, the IRS publications are going to tell you who is prohibited and who is not, or we can here at Growth Equity Group. And again, what are the benefits of taking your dollars out of a Vanguard, out of a Merrill Lynch, out of a Charles Schwab account, where you have somebody making your own investment decisions, taking commissions off of you? You can invest in what you understand and can control. Nothing is better than owning a tangible asset that you make your money 3 ways. A, cash flow, right? B, appreciation. Number C, when you have debt on income-producing real estate, every time that tenant makes a cash flowing payment and you pay down your principal on your debt, you are realizing cash flow there. You don't realize it till the day you sell, but that is true income. And be able to diversify. A lot of our clients, they have their money in stocks, bonds, and mutual funds, but they know that they need to diversify. You can't put your eggs all in one basket. You can't put your eggs all in one market. And the other thing is reduced restrictions. You can buy and sell a house in your IRA. I've done it myself. I've bought and sold within a week. I've flipped property on my IRA. Is that the best way to invest in my IRA? I don't believe so. I believe the best way to invest and how I love to invest in my IRA is long-term investments. Investments that I'm going to have that I might not only want to own for myself, but I want to pass on to my heirs. A lot of clients ask us these questions. What about my uninvested money? Every trustee, every custodian that we work with is FDIC insured. Is there a minimum to opening a truly self-directed IRA? Yes, it's a $3,000 minimum to open that account. We had a client recently that did a maximum contribution, $5,600 for the Roth IRA. They vested 3% in their brand new Roth, 97% in their traditional into their investment. And you can do that. Our client said, I want to start getting returns into my new Roth IRA. And we said, there's no problem. Our attorneys can do that. We can have you own that real estate in that way. What is a timeline? It all depends on who your current custodian is. It's anywhere from 2 to 6 weeks. Again, you do not have to take 100% of those dollars. If you have $100,000 and you want to take $50,000 and make it truly self-directed, you could do that. Again, you don't have to take 100%. What is the timeline for your first investment? You can go under contract within 48 hours. The custodians that we work with will have an account number, and that's all you need. Within a 48-hour time period, you can go under contract, and you can be on your way to owning tangible real estate in a retirement account. Again, we work with all the nation's retirement accounts, and we've taken it one step further. We have an arm of our company called Equity IRA. Now, Equity IRA works with several of the best custodians, in our opinion. And what Equity IRA does is it's back end to the custodians. We are able to facilitate quick openings of accounts, all the answers that you need, all the numbers with your account, all the facilitation of moving your money from whether it's Charles Schwab or Vanguard to your new self-directed account. This business is to help you. The biggest problem that we found with custodians, if you've dealt with a custodian before, you have Pensco, IRA Services Trust, Provident, Equity Trust, is they work bankers' hours. Our clients are professionals. They work during business hours. They don't have time to work on their retirement investing during their business hours. So what we found is a lot of these custodians, they're only open during business hours, and a lot of our clients were getting frustrated. So we have staff here from 9 a.m. Central to 9 p.m. Central that can facilitate those transactions for you. And for attending the webinar this evening, we'll give you a $50 off agency fee, which establishes with Equity IRA to set up your self-directed. Again, because you are on the webinar, we have your name, of course, and we will be able to take care of you with this voucher. Again, it's free to have a consultation. It costs no money to have the consultation, and you can see if your account is able to self-direct. Because here's another big thing. A lot of individuals that have a current 401k, we've seen from about 5 to 7% of accounts be able to actually go self-directed 5 years ago to now we're probably up around 20% of current employers that will allow for self-directed. So what you can do is either call us at 773-634-8609 or email info@equityira, and we can get you your answers and set you up with your free consultation. Now I'm going to get into Growth Equity Group, who we are, what we do, and why you, the investor, might want to take advantage of what is happening in emerging markets, college towns, and urban markets in the United States right now. Our firm, I myself have been doing this since 2003. We have over 25 years combined experience. It's pretty incredible what we have done, especially the last 5 years, raising money from retirement accounts, showing individuals how they can utilize what we like to call, emerging markets, college towns, and urban markets. We are your evaluator. We are out there every single day analyzing markets, not only our own market. We're based here in Chicago. Do we have real estate in Chicago? Yes, absolutely. But is Chicago the only market that we deal in? No. I'm going to tell you about one market in the United States that is on absolute fire right now. We have purchased and sold over 500 units in this individual market. And the reason I'm going to tell you what is happening in this emerging market is incredible. Again, your lender. Every property that we sell comes with financing to you, non-recourse, meaning the lender is not looking at you as an individual. They're looking at your real estate that you're buying and how it's performing. Now, this is pre-approved. All the underwriting has been done on every single asset that we sell. The rates, anywhere between 5 and 6%. Right now, market non-recourse financing is anywhere from 8 to 12%. We are killing the competition because our real estate has the equity, has the cash flow, and is just the kind of asset that the lender is looking to have on their books. Your manager. Every piece of real estate that we sell comes with A, a tenant in place, and B, management in place. Do we sell the real estate to you, wipe our hands and say, good luck? We are not a brokerage. We do not do that. We have software. It is called gegmanager.com. Look it up, gegmanager.com. We're up for a couple of awards right now for our software. Our software is available to you 24/7 when you own the real estate. We want it to be no different than owning a stock. We want you to be able to log in, see your income, see your expenses, see how your net return is there on a monthly basis, any open work orders, any communication with the association, anything that's happening is right there in GEG Manager. And again, your partner. We are in with every asset we sell from acquisition to disposition. It is not in our best interest to just sell real estate to our clients. This is a relationship business. We want to put you into markets that you're going to buy today. You're going to capitalize double-digit returns on a monthly basis. You're going to sell in 3, 4, 5, 6 years, or depending if it's your goal to pay off the debt and own it free and clear forever. We're going to know this. We know every one of our clients and what makes the most sense to them, and we're going to help you achieve your goals. Again, here's the markets that we believe in the United States right now that you make money. Emerging markets. If you look right there, it says the Port of Virginia. I'm going to give you a little insight. The Panama Canal right now is going through a $6 billion expansion. Panama Canal is, of course, a shortcut to the eastern seaboard of the United States for importing and exporting. Well, guess what? There is only one port on the eastern seaboard that is wide enough and deep enough to accept the ships that they call them post-Panamax ships, and that is the Port of Virginia. The last 18 months, Growth Equity Group has been investing heavily in the market right around the Port of Virginia. We are talking about a $60 billion impact. The Port of Virginia is set to have a $60 billion impact. The Port of LA over the next 5 years is set to lose 25% of their business. Do we want to be investing in real estate there today? Because the Port of Virginia and the Panama Canal expansion, this is 2016, mid to late 2016. We have a small window. College towns. College towns are huge. College towns continue to thrive and continue to grow. Are we renting to college students? No. We're renting in the area that the college towns have the impact on employment, that properties continue to appreciate. Rental rates continue to go up, in some cases double digits on an annual basis based on population growth into these college towns. Less and less kids are going home in the summertime. They're living. They're adding jobs to the local area, which is adding businesses, which is adding growth. We have an opportunity tonight I'm going to talk about in Virginia that has grown almost 3 times the size in the last 15 years, that is walking distance to the college. And then urban markets. Here's a great landscape photo of my city of Chicago. We have opportunities in Chicago. What's so great about urban markets, especially Chicago, because some urban markets like a Manhattan are unaffordable. But cities like Chicago still have affordability. But the great part about cities like Chicago, Midwest city, that is booming right now with a generation class that we call millennials. Millennials are individuals by the age of 22 to 32 that used to, at the age of 26, 27, after their second job, making $60,000, $70,000, $80,000 a year, used to buy their first property. Now in urban markets, they're not doing that. The last 5 towers that have gone up in Chicago that were supposed to be condominiums are high-end luxury apartment buildings. But what it's doing to the families, the young families, is pushing them to the nice suburbs of Chicago, where you can capitalize on the nice suburbs of Chicago, just like the markets that, if you've heard of Blackstone, or of course their largest single family homeowner, Invitation Homes, or American Homes for Rent, or Colony Homes, all of these markets that we're buying in are the exact same markets that these REITs are buying in. But the great part about it is when we're buying small tranches of real estate in markets where the big boys are buying and turning into REITs, we're able to capitalize on them taking inventory off the market. The software I talked about, GEG Management. Here's a little screen that's going to show you kind of what it is, how it looks like. You can view your statements online, view your work orders, so you can communicate with us directly. It's available to your cell phone, your tablet. This software is incredible. It is all there for transparency to show you how your investment is performing. We only buy bulk real estate. So what does that mean? Well, very similar to a Costco or a Walmart. We don't buy one-off properties on courthouse steps. That really doesn't happen anymore, but we don't do that. We look for sellers who are buying in bulk. Why do we do that? Because in today's market, that is where the discount is. And when we buy in bulk, our primary acquisition is between $5 million and $15 million. We are able to pass on savings to our clientele. The other thing we look at is supply. We're not buying in bulk in Detroit, because the supply in Detroit would be anywhere between 18 and 36 months. Plus, we're buying in emerging markets, college towns, and urban markets where we are a niche buyer. We are able to come in, make a great deal, and be able to acquire units where our investors can leverage those units and earn double-digit returns month in and month out. We live and breathe real estate investment. I'm here right now. It's 8:30 Central. I would be here if it was 8:30 Central, not doing the webinar. Our office last night, I think the last person left probably about 12:30 a.m. in the morning. Here's another thing that we love to look at. When you think about real estate investing, have you ever thought about, well, I want to know the future. I want to know what the future yields for this certain submarket within any market. What our firm learned a long time ago was we need to take our due diligence a bit further. We need to go in, we need to get our knees dirty. We need to get our elbows dirty. We need to find out what is going to happen in these markets. And we found one of the best ways to do this is building permits. Have you ever purchased real estate, but prior to purchasing investment real estate, gone down and pulled building permits to see what's going to happen within a mile radius of your development or your property you're purchasing? More than likely, the answer to that is no. We do that. When we're buying developments, we buy everything as we are going to own it, that we're never going to sell it. The proper due diligence is not only done here in our office in Chicago with all the technology we have between CoStar, between our brokers, between just getting dirty on the internet and finding out what's going on in these markets, is we actually go to these markets and we do the heavy due diligence that we have to do, not only for ourselves, but we want to have it for our investors. We want our clientele to be able to purchase real estate today, whether it's in the retirement account, a new LLC, whether they're a foreign national, and be able to earn double-digit returns, sell it in 3 to 4 years, double their money, and purchase the next asset that's going to yield them amazing results. Look at this, the state of Virginia. Here's a great trend that I love to see. I mean, I love to see an uptick. Of course, we're going to see the market decline in years 7, 8, 9, 10, but you see an uptick early. The general state of Virginia, in the biggest decline in real estate's history since the Great Depression, beat inflation. We saw appreciation of anywhere from 4 to 5%. Right now, we're seeing double-digit appreciation in some of the sub-markets that we're buying in. And the reason is we're talking about double-digit population growth in these sub-markets. Why? Of course, the Panama Canal expansion. What it's going to do to the way that the United States imports goods again is incredible. And this is all happening in the state of Virginia, all over, even the college towns. I mean, we're talking Harrisonburg, which is 2.5 hours from here. But we're seeing growth in this small college town that's gone from 8,000 students to 20,000 students because of not only the Panama Canal expansion, not only what's happening in the state of Virginia and the funding in the state of Virginia, actually trickled down from D.C. as well. Economics 101. You know, real estate, especially residential real estate, is very simple. We specialize, again, in condominium developments, townhome developments, single-family homes, and small multifamily. When I say small multifamily, I'm talking, anywhere from 4 to 9 units under $750,000. Again, every one of the assets that we have comes with financing in place. But economics 101, we have to understand the cycle. There's so many companies out there today that specialize in their own one market. The problem with that, though, is if you specialize in your own one market consistently, is that always the best market to be investing in? No, it makes zero sense. You have to be able to diversify. You have to go in front of where the opportunity is. You have to be able to see that opportunity. And when you buy at the right time, everything's about timing, you can create the best return on that investment. I can tell you that over 2010, 11, 12, I spent a lot of time in Florida. We did a lot of deals in Florida. I was on the phone with a broker today. He just sold a property on essentially a negative return, a return that was going to yield the investor only speculation. Does that make any sense? especially if you're investing in a retirement account. If I'm making a double-digit return and I'm paying down debt, I could own a property free and clear in 7 years by utilizing what that tenant is paying me. How powerful is that? Nothing can touch that in today's market. What's another thing we look at? We use a lot of technology when we're looking at absorption rates, what's happening with comparable sales. A great system that we use a lot of is it's called CoStar. CoStar, they now own apartments.com. The data that we're getting from apartments.com is incredible. They also own LoopNet. They are a monster, but they only do business with real estate professionals. It's a very expensive software, but we're able to go into any one sub-market that we're buying in, and we get to see how fast properties are trading. When I say trading, I mean selling, how fast properties are renting. We want to do this all front end before we make any acquisition. Not only do we do this, but every property that we sell, again, comes with financing in place. So once we do our due diligence and give a seller an offer on that property, our financing partners come in and they look at the deal on its own 2 feet. They don't care how we feel about the deal. They ask us, how much do you expect to purchase this property for? How much do you expect to sell it for to your investors? And what kind of return? And then they go out and they do their own due diligence, and they're the ones that are setting the prices that we can sell the property for, because of course they are the lender. So we're just not out there setting prices and putting financing in place. We have rates and terms from lenders on every deal that is non-recourse. If you walk in tomorrow to our office and said you had X amount of dollars and wanted to purchase real estate and you wanted to close in 3 days with that loan in place, without giving your credit, without talking to them about your other assets, without them showing a tax return, we would say, fine, we can do that. Comparable sales, comparable rentals, all of this is done on every property. Traditionally, what we like to do is keep our comparable rents anywhere from 3 to 5% below market. Why do we do that? Why wouldn't we take our rents to 100% of market? Well, vacancy is a killer in real estate. A lot of firms don't realize that. They want to push the envelope. But when you push the envelope, you push out tenants. We want to keep our tenants in our units. We want to keep our tenants signing new leases. Does that mean if we keep our rents 3 to 5% below market, that they do not sign new leases that are growing in value? Absolutely not. But they're staying behind market, that we keep those tenants in the property, which again is going to yield us the best results. Inflation rates. Right now, the United States is saying that we're at an inflationary rate of 1.6%. If I could show a show of hands of individuals on this webinar, and it would be a pretty big room, a gymnasium full of individuals, I think that would raise their hands saying that, are we above a 1.6% inflationary rate? I don't understand how it's 1.6%, especially not factoring in food costs. Maybe with the new news this week on Whole Foods, having to figure out how to make money and how to really attract those millennials. Maybe that's why. But food costs continues to go up. Us being a developer by trade and having to buy building materials all the time. National Gypsum in 2013 doubled the amount we pay for drywall. I just don't understand how that number is going down. It makes zero sense to me, but you know what? I believe we're in an inflationary period. We like to say that 3.4% is the national average. That's what, if you're buying in a great market like we're showing you, that's the maximum we're going to show you that your property is going to grow. Here's from our dear friends Marcus and Millichap, rents raising rapidly. we're looking at over a 20% gain over the last 5 years in rental rates. Developers, again, just like the last 5 developers in Chicago that developed these condominium towers that instead of selling them off to individual moms and pops with realtors that they had to deal with the headaches, they put long-term debt on these properties. They rented them up to millennials at unbelievable rates where they were getting a great return based on their building costs, and then they're selling these properties to pension funds. It is incredible what's happening right now. But while they're doing that, us being residential owners of real estate, we get to capitalize on that because they're taking inventory off the market. Landlord income is skyrocketing. This is from the United States Department of Commerce. I'm going to tell you a little story about one of my properties that I rented here in Chicago. It's now about 5 months ago. It was rented for it's a row home. Used to be my own home. It was rented for $2,400 on a 2-year lease that came up about 5 months ago. Did the old turn on the property, put it on the market. It was on the market for 1 day, had 6 offers, and I rented it for $3,000. $600 above what I already had it rented for. It rented to an attorney for United that was 28 years old. He has since emailed me and asked if he can have a 12-month extension on his lease. And I've yet to answer that email because with where the market's going and what's happening in these urban markets, it's incredible. Do we want to own stock in a national home builder? Have they been performing well? Sure. Building is back. It's happening. But what are we missing out on? Are we missing out on cash flow? Absolutely. Who's making the money? Is it us or them? Where's the money to be made? In the residential real estate, in the income producing real estate, that is where you are going to make your money today. Here's some recent media on this is just kind of a highlight of the markets that we go into, what is happening. This is a recent article in Virginia. This is from American Airlines, the little magazines that they have on the airplanes. This was never a vacation destination, and it's becoming a vacation destination because of the amount of dollars coming in here. If you've ever been to Washington, D.C., it's a very similar climate. It's about 2 hours from D.C. Here's Canon. They're doing a $100 million expansion in our Newport News market, which is the Hampton Roads of Virginia, which we have an opportunity. I believe we might have 1 or 2 units left. Ferguson is a national bathware product manufacturer. They're up 10%. I would say, why their stock is up 10% and revenues above $12 million halfway through the year, or $12 billion halfway through the year, is due to building coming back. One of my favorite slides up here, the next slide here, is a study from the Washington Times. The Port of Virginia is going to have a $60 billion impact. $60 billion. This is huge. We will only be buying real estate in this market for another 6 to 12 months. Reason being because the secret is out. We cannot buy real estate that's only going to have a 3, 4, 5% return. It doesn't make any sense for all of us on the call tonight. We can earn double-digit returns in emerging markets. We want to own real estate here today. We want to be sellers in 3, 4, 5 years. Now, again, the problem identified for real estate investors, especially those self-directed, stocks, bonds, mutual funds, are they creating that contracted cash flow, that a lease? If you have a lease, you know how much money is coming in every month. You know what your debt is. You know what your taxes are. You know what your expenses are. I like to say it's not a guaranteed return, absolutely not, but it's contracted return. I have a contract in place, that lease, that's going to show me what kind of return I have. Will stocks, bonds, and mutual funds give you that 12 months in the future? They will not. Leverage. If somebody told you, if you think you're a good trader, or you are a good trader, and somebody said, John Doe, I'll give you, if you have $100,000 in your IRA, and I'll give you another $100,000 at a 5% rate, do you think you could take advantage of that 200 grand and double down? Possibly. But with real estate, the great part about it is it's all based on that asset. It's all based on that contracted return. It's all based on the value of that property. Appreciation. I know appreciation has been a dirty word in years past, but it's happening. It's happening all over the place in the United States again. And why that is because we had 5 years that we didn't build. If we're buying real estate in the correct markets today, you will have appreciation. Diversification. Do we want to put all of our eggs in one basket? We have a lot of clients that have money, stocks, bonds, and mutual fund, gold, and cash flowing real estate with us. A lot of them liquidated their gold 6 to 12 months back and bought more real estate from us. But is there opportunity there? Absolutely. And think about it, tenants paying down your principal. Non-recourse financing, I know I've said it a few times, I just want to highlight it on it. That is collateral-based financing, and it is the only financing that a truly self-directed IRA can have because there is no recourse to you, the individual. That is the only way that you can own debt with your truly self-directed IRA. Back to the Panama Canal. Think about this. We're talking about a $60 billion impact. $700 million going in right now in distribution centers. $250 million in highways and railroads. Here's another great thing. The largest military presence in the world. Over 100,000 active military in this submarket. The Port of LA is set to lose 25% of its business over the next 5 years to the Port of Virginia. Is this a big deal? Absolutely. And you can take care of it. And you can take advantage, on a micro level. Here's a little illustration. This is the third canal. This is the third lock. They're actually talking about a fourth lock right now, which is going to be over $20 billion. But this is over a $6 billion project that is going to change the way that the United States imports goods. This is a shortcut. Think about it. Think about New York, Florida. Think about all these submarkets on the East Coast that have been just dying because they're waiting for goods to come all the way across the West Coast to the East Coast. Now the shortcut is here again. What we love to call this again is an emerging market. I'm going to show you a recent acquisition that we have, the kind of quality of rehab that we do, kind of property that we do. This is Charlestown. This is the second property that we bought from the seller. This was a seller that was is a large hotel operator in the East Coast. They are what I would call an accidental landlord. They are a landlord that purchased real estate, multifamily real estate in the years 2005, 6, 7, improved the property or improved the balance of the property, sold off units, and then got stuck with inventory when, of course, the market died, and they ended up being landlords and owning and renting out units to individuals. The great part about properties like Charlestown is when I go to buy this inventory, I have a running 36-month or even here a 60-month trailing bookkeeping where I can look at and I can see what's good, what's bad, what's ugly about the property, where we can go in and improve to make the tenant experience and the owner experience better. Again, this is Charlestown. I think we might have 1 or 2 units left. This is an improved townhome unit here. I'm going to show you an illustration of what it looked like before here shortly. Again, this is right across the street from a school. This is 7 minutes from the Port of Virginia and the naval base. This is huge. These again are first floor, second floor, so they have the feeling of, or of course, of a townhome. The great part about communities like this here is it's a total of 240 units. We purchased 50 units. You have 190 units of owner occupants out there who are not only caring for their property day in and day out, but your tenant base has what we like to call pride of ownership. Every time they go into a property or their development, uh, they're not going into an apartment complex. They're going into a complex that people own, people live. And that's what we like. Urban markets, again, millennials, let's capitalize on this right now. The numbers, the appreciation, the rental rates that's happening in Chicagoland are crazy. 900 building permits per 1,000 new residents. That's crazy. That's not happening anywhere else in the United States. Number 2 in residential construction, $1 billion in startups. Google, their new building here is insane. I know everybody says Google has a new building coming into their submarket, but what the takeover that they have right now in the West Loop is crazy. Here's kind of the property that we have, the rehab property. These again are in neighborhoods, just like Invitation Homes. I'm not going to bring up numbers on the slides right now because every property that we have has a different selling price, has a different financing aspect to it. So we ask that you call in directly or you contact info at Growth Equity Group directly, and we'll show you how the numbers can pan out for you. Again, properties that we like to rehab here, we have 42-inch cabinets. We're not going to Menards and spending $1,500 on a kitchen. We're spending $5,000, $6,000 where a tenant is not only going to want to live, but the tenant's possibly going to want to buy that property from us. Another great asset class that we have here in Chicago is multifamily. Talk about diversifying. We have these buildings that are built in the 70s and 80s that are incredible. They're all rehabbed, 100% tenants in place, financing in place, unbelievable financing terms on these multifamily properties that you are able to take advantage of, whether it's in your self-directed IRA, if you're foreign national, or cash on hand. And here's our newest acquisition. This is in Harrisonburg, Virginia. It's here just a few weeks back. This is the home of James Madison, ranked number 1 place to be a millennial in 2014. This town is on fire. It's actually ranked the number 2 safest metro area in the South, number 2 top public college in the South, and featured in Bloomberg's top 40 business programs. The football program is growing like crazy here. This college town has gone from 8,000 students 15 years ago to over 20,000. Our property here is University Place. This is a condominium property. This is within 6 blocks of the campus. We do not rent this to students. We rent this to faculty. Here's an image of a newly rehabbed unit at University Place. And the price point that you're into these properties, let me just call it round numbers, $50,000. It is incredible, the value here and the upside potential that you can do with $50,000. We've added washers and dryers, which is huge to the property because you don't have to go off-site to do this. Here's another great thing that we have. Our manager on this property has been managing university for over 15 years. This maintenance, while it looks like a mess to some of you, we have everything on hand that we need to keep your expenses in the future low. How important is that as a real estate investor? Because one thing, the biggest killer is maintenance. I mean, vacancy, of course, but maintenance is a killer too. We don't have to hire a third-party company to go out to our property. We have maintenance here on staff that is able to take care of your property and keep any future expenses low. So have we covered all the bases? Market timing. It's all about market timing. Are the markets, just like let's talk about Virginia, the Hampton Roads area of Virginia. Are we going to be in that market for the next 5 years as buyers? We're not. Because what's going to happen there is that they're going to have double-digit population growth. They're going to have individuals coming in that are buying up property, that are buying up over market. Whole Foods just came in there, and I talked about Whole Foods earlier, but about 6 months ago, they just bought dirt for twice what market is because they have to be there. Interest rates. The interest rates on our non-recourse mortgages, anywhere from 5 to 6%. Diversify. How important is it, especially as an investor, as any investor, to diversify? But we want to be in different asset classes. We want to be able to earn our income differently. And again, if we can own property, real property, rental property in our retirement account, when we retire free and clear, and think about it, if you have a Roth and you're able to take that income tax-free and then pass that property on to your heirs, how powerful is that? Tangible real estate or tangible assets are the only protection, we believe, from inflation. You have cash flow, financing in place, and we do not sell any real estate without tenants in place. Please go to growthequitygroup.com. We have a couple free books for you. The 4 greatest challenges facing self-directed IRA investors. And then we want to show you what you can and cannot do with that self-directed IRA. And you can call us right now. We have staff on hand if you want to talk about returns, you want to see prices of properties, you want to talk more about it. Write this phone number down, 866-904-3336. Or you can email, and I'll get this email directly at info@growthequitygroup.com. Again, 866-904-3336 or info@growthequitygroup.com. We can talk about everything we talked about in the webinar. We have, again, staff on hand. I have 15 people out there ready to answer the phones and talk to you about available inventory, what the numbers look like, what kind of returns you're going to have. If you have questions about self-directing, we can answer all that for you. And again, I want to thank you for coming out on this Thursday night. Again, I'm looking at the full moon right outside my office window downtown Chicago. It's pretty incredible. I hope everybody's summer is going well. Hope all the kids are having fun, and we'll talk to you soon.